An increase is arriving in your Social Security payment. Chances are you have already seen the announcement. But before you factor that additional money into your monthly budget, there are facts you need to understand about what is actually happening to that payment. Facts that will determine whether you keep that money or lose it without ever realizing it disappeared. 3 distinct mechanisms are affecting your benefit at this very moment. Not in some distant future session of Congress. Not pending some hypothetical legislation. Right now, during these specific months. In this exact season. The first mechanism reclaims the majority of your increase before the funds ever appear in your account. The second imposes an additional charge you never agreed to, calculated using income from a tax year that ended over 24 months ago. The third has the capacity to halt your payment delivery entirely if you fail to take a specific action before a hard deadline passes. What makes each of these mechanisms genuinely dangerous is that none of them were engineered to attract your attention. There is no automated phone notification. There is no prominently worded advisory letter arriving in bold red ink. The design, and I use that word deliberately, is for you to discover what happened only when you open a bank statement or hold a deposit slip and realize the number is wrong. By that point, the funds have already been redirected, and the window to act may have already narrowed. The convergence of timing is what elevates this from a general concern to an immediate one. These are not dormant provisions buried in decades-old legislation. The relevant notices, adjustments, and deadlines are landing simultaneously. The cost of living increase, the surcharge determinations, the transition away from physical check delivery. All of it is unfolding on kitchen counters and in mailboxes across every state in the country during these very weeks. That means the opportunity to position yourself ahead of these changes exists right now. Not after the holidays. Not when the next tax season rolls around. This summer, while you still retain every available option. And there is one additional detail I need you to hold on to. For one of these 3 changes, the vast majority of people who are negatively affected already meet every qualification necessary to eliminate the impact entirely. They qualify today. They have qualified for months or even years. Yet, an overwhelming percentage of them never submit the required paperwork for the sole reason that no one ever informed them the paperwork existed. Before this presentation concludes, I will identify which change that applies to, and I will tell you precisely where the remedy is located. My name is Kevin. I study the regulatory language so that you are not forced to decipher it alone. If this is your first time here, this channel serves a single function. We examine the fine print that governs what happens to your income, so that you receive that information before the system makes decisions on your behalf. Subscribe now and activate notifications, because at minimum, one of these 3 changes is going to directly impact someone in your family. Change number 1, the raise that never arrives. Let me begin with the first mechanism, because it operates behind a layer of apparent good news. Each calendar year, the Social Security Administration announces an adjustment to benefit payments. The formal designation is the Cost of Living Adjustment, commonly abbreviated as COLA. The announcement generates widespread media coverage. Headlines declare that recipients will receive a percentage increase. And across the country, millions of individuals on fixed incomes experience a moment of cautious optimism, a bit more arriving each month. Some modest breathing room. At last. But here is the critical detail that never accompanies those headlines. The single largest recurring health expense carried by the majority of seniors, the Medicare Part B monthly premium, is deducted directly from the Social Security payment before the recipient ever lays eyes on the deposit. This is not a bill that arrives separately. It is not an invoice you review and authorize. The amount is subtracted automatically, at the source, every single month, with no action required from you and no approval sought. Now consider the structural problem. That Part B premium also increases. Frequently, it increases substantially. So when the cost of living adjustment adds a certain dollar amount to your gross benefit, the simultaneous premium increase reaches into that identical payment and extracts a portion of the newly added funds right back out. In numerous years, the premium increase has consumed nearly the entire raise. For certain categories of recipients, it has consumed the whole thing. The result is a public announcement declaring you received an increase, while the actual figure deposited into your account, the number that pays for groceries, utilities, and medication, shifted by almost nothing, or in some documented cases, did not shift at all. This outcome is not a glitch. It is not an oversight. It is the mathematical consequence of two separate adjustments applied to the same payment, and the failure of any official communication to present them together in a way an ordinary person would immediately comprehend. The structural inadequacy runs deeper still. The cost of living calculation itself is anchored to a price index that was never calibrated around the spending patterns of retired Americans. The Consumer Price Index used for COLA determination weighs categories like transportation fuel, general consumer goods, and items associated with commuting and active employment, expenditures that dominate the budgets of working-age households. It assigns comparatively less weight to the categories that actually devastate a retiree's finances: outpatient medical care, prescription medications, supplemental insurance, assisted living costs, and the steadily climbing expense of maintaining housing on a diminishing income. The prices that erode your purchasing power most aggressively are precisely the prices that rise faster than the index used to calculate your adjustment. This means that even in a hypothetical scenario where the premium never touched your raise, the raise itself was already insufficient from the moment it was computed. It was structurally behind from the start. Every single year. By design, your cost of living adjustment is not maintaining your standard of living. It is decelerating the rate at which your standard of living declines. There is an enormous difference between those two things, and no official correspondence you receive will ever articulate that difference. There is an additional dimension to this problem that rarely enters the conversation. Many recipients carry supplemental insurance, Medigap policies, Medicare Advantage plan premiums, prescription drug plan costs, and those premiums also tend to increase annually. These additional increases are not subject to the same limited protections that exist for Part B. They operate independently, and they compound the erosion. A retiree who sees a $40 COLA increase may simultaneously absorb a Part B premium hike, a Part D premium increase, and a Medigap rate adjustment. The net result can be a check that is functionally smaller than the previous year, despite an official announcement of an increase. Furthermore, property tax reassessments in many jurisdictions trend upward on cycles that have no relationship whatsoever to Social Security adjustment schedules. A county can reassess property values and raise the tax burden in the same calendar year that a minimal COLA is announced, creating a compounding squeeze that the federal adjustment was never designed to address. Let me illustrate this with a specific situation. Consider a man I will call Roscoe. He is 72 years old, a resident of a small city in central Ohio. He spent 31 years operating a delivery route for a local bakery. Identical roads, identical stops, every morning before sunrise. When the annual raise was publicized, Roscoe conducted his own arithmetic at his kitchen table. His previous monthly payment had been approximately $1,800. The announced adjustment should have added roughly $40. For Roscoe, $40 was not abstract. That figure covered his electricity during cold months. It was tangible, and it mattered. When the first adjusted payment arrived, the deposited amount was virtually unchanged from the prior month. Not $40 higher, barely a handful of dollars different. He repeated his calculations. The arithmetic was correct. The increase had been applied. It simply never reached his account. The Part B premium had risen by nearly the identical amount during the identical billing cycle, absorbing almost the entirety of the adjustment before the funds ever departed the federal payment system. No correspondence arrived explaining that his increase had been effectively neutralized. He received one notice congratulating him on the adjustment, and a separate, less prominent document regarding his updated premium, two communications drafted so that a typical recipient would never think to place them beside each other and compare the figures. Now, some of you are aware that a protection exists. You may have encountered a reference to it. That awareness is partially correct, and partial correctness is precisely the kind of knowledge the system exploits. A provision does exist. Its purpose is to prevent the Part B premium increase from exceeding the dollar value of your COLA, so that your net payment never decreases purely because of the premium. But the boundaries of that provision are far narrower than most people assume. It does not apply to individuals in their initial year of Medicare enrollment. It does not apply to anyone whose income triggers the surcharge I will address shortly. It does not apply in every state program configuration. And even when it does apply, it only guarantees that your payment will not shrink. It makes no guarantee whatsoever that your increase will actually reach you in usable form. If you are finding value in this information, take a moment to hit the like button and leave a comment below telling me which of these changes concerns you most. Subscribe and turn on the bell so you are notified every time we break down another rule that affects your money. Your engagement helps us reach more people who need it. Change number 2. The surcharge from your past, now the second mechanism. If the first one unsettled you, this one demands your full concentration. Because this provision reaches backward through time and imposes a financial penalty based on circumstances that may no longer exist in your life. The federal government possesses the authority to increase the amount deducted from your Social Security payment based on income you reported 2 full tax years prior. Not your current income. Not your income from the most recent filing. The income from the tax year before that one. The formal designation is the Income-Related Monthly Adjustment Amount. It is universally referred to by its acronym, IRMAA. The underlying logic is straightforward in principle. If your income exceeded a specified threshold, the government determines that you possess the financial capacity to contribute more toward your Medicare coverage, and it adds a surcharge on top of the standard Part B premium. That surcharge, like the premium itself, is extracted directly from your Social Security payment. The surcharge operates on a tiered structure. The further your income exceeded the threshold, the higher the surcharge climbs. But the tiers do not transition gradually. They function as cliffs. You can exceed a threshold by a trivial amount, a few $100s, sometimes even less, and the surcharge jumps to the next bracket in its entirety. There is no proportional scaling. There is no gentle transition. To put this in concrete terms, envision 2 individuals living on the same street. One reported income that fell just below a particular IRMAA threshold. The other reported income that exceeded it by a marginal sum. That marginal difference does not produce a marginal increase in cost. It can produce a difference of hundreds of dollars per year. In certain brackets, the annual difference exceeds $1,000 for crossing a single line by an insignificant amount. What many people fail to recognize is that IRMAA does not only affect Part B. There is a corresponding surcharge applied to Medicare Part D, prescription drug coverage. This means that individuals above the income thresholds are absorbing increased costs on 2 separate fronts simultaneously, both deducted from the same Social Security payment. The combined impact of Part B and Part D surcharges can be staggering, particularly for individuals who had no understanding that either one was coming. Additionally, the income figure the government uses is your modified adjusted gross income, which includes categories many retirees do not expect. Tax-exempt bond interest, for instance, is added back into the calculation. Capital gains from investment portfolio rebalancing count. Required minimum distributions from retirement accounts count. Even a Roth IRA conversion, a strategy many financial advisors recommend for long-term tax efficiency, can temporarily inflate magi and trigger IRMAA brackets that persist in your payment deductions for 24 months. Now here is the element that devastates careful, responsible people who plan diligently for their retirement. The government does not examine your present financial circumstances. It examines your tax return from 2 calendar years ago, because that is the most recent return they have fully processed and reviewed. The consequence is severe. A single financially significant event occurring one time, 2 years in the past, can elevate the amount deducted from your current monthly payment, even if your income has since plummeted. Even if you are currently living on a fraction of what that old return showed, the triggering events are almost always one-time occurrences. You sold residential property. You liquidated an investment account to cover a medical emergency. You took a larger than usual distribution from a retirement fund to pay off a debt. You had one final year of full employment income before transitioning completely into retirement. For 1 year, on one tax document, your income appeared elevated. That year concluded. That money was spent. But the surcharge materializes 24 months later, and it extracts its cost every single month for the entire benefit year. Consider a woman I will call Maybelle. She is 74, living in a mountainous region of western North Carolina. 2 years prior, she made a thoroughly rational decision. She sold the family home. The structure had become unmanageable. Excessive square footage. A staircase that had become a daily hazard. A property that demanded physical maintenance beyond her capacity. She used the proceeds to relocate into a modest residence near her adult daughter. That transaction, for that single tax year, inflated her reportable income dramatically. On paper exclusively, The capital from the sale was largely consumed by the purchase of her new, smaller home and the associated transition costs. Very little remained as liquid assets. This year, a surcharge appeared in her Medicare determination, a new, higher amount, subtracted from her Social Security payment every month, directly tied to a property she sold, moved away from, and no longer has any connection to. She contacted Medicare, certain an error had been made. No error existed. The system was performing exactly as programmed. The surcharge has no mechanism for recognizing that the money is gone. It recognizes only what the tax return reported 24 months earlier. There is a related scenario that affects an increasing number of retirees as tax law interacts with retirement planning. Individuals who perform Roth conversions, transferring funds from traditional IRAs to Roth IRAs to reduce future required distributions and tax liability, temporarily spike their taxable income in the conversion year. 2 years later, IRMAA arrives. The conversion may have been financially prudent over a 10-year horizon, but the surcharge imposes an immediate, recurring cost that the converting individual almost certainly did not factor into their planning. Financial advisors who recommend these conversions do not always warn clients about the IRMAA consequences, and the clients discover the cost only when the deduction appears in their benefit statement. And there is another pathway through which this provision inflicts damage, and it is particularly merciless. It targets surviving spouses. Consider a woman I will call Juanita. She is 71, living in southern Colorado. Her husband died the previous year. During the period of mourning, a tax consequence emerged that no one had cautioned her about. While both spouses were alive, they filed a joint tax return. The income threshold the government uses to determine the surcharge is set at a substantially higher level for joint filers. Their combined household income fell comfortably beneath that threshold. When a spouse dies and the surviving partner begins filing as a single individual, that threshold drops precipitously. The identical household income, or even a reduced version of it, since one earner is now deceased, can suddenly breach the single filer threshold. The surviving spouse did not earn additional income. In reality, total household resources diminished, but the filing status change altered which threshold applied, and the surcharge activated. Juanita lost her husband. Months afterward, the federal government began extracting a larger amount from her monthly payment, for the mathematical consequence of becoming one tax filer instead of two. The provision does not recognize bereavement. It does not account for emotional devastation. It processes filing status and income figures, nothing more. The cruelty of the timing compounds the injury. The surcharge determination does not arrive during the acute phase of loss, when community support is present and family members are nearby. It surfaces a year or more later, after the neighbors have resumed their routines, after the regular phone calls have tapered, when the surviving spouse is most isolated and least psychologically equipped to contest a bureaucratic determination. That is not intentional malice. It is something arguably worse: complete institutional indifference to human circumstances. If this information is relevant to your situation or to someone you care about, please take a moment to like this video and share it. Leave a comment below if you or a family member has encountered any of these surcharges. Subscribe and activate the bell for notifications. These are the details that official notices never explain clearly, and this channel exists to fill that gap. Now here is the information that transforms this from a distressing problem into a solvable one. The majority of people who receive a surcharge notice treat it as a final, irreversible determination. An automated system generated it. An official seal accompanies it. What recourse could possibly exist? That assumption is the most financially costly mistake discussed in this entire presentation. A specific administrative process exists for exactly this circumstance. If the elevated income that triggered your surcharge resulted from a qualifying life event, retirement from employment, cessation of work activity, loss of a spouse, divorce, loss of income-producing property, or reduction or loss of pension income, you have the ability to formally request that the government recalculate your surcharge based on your current financial reality rather than the outdated tax return. The mechanism is a form designated SSA 44. It accompanies a defined list of qualifying life changes. There is a submission window, and when the request is approved, the surcharge is removed. The monthly deduction decreases. The payment amount recovers. In certain cases, the adjustment is applied retroactively to the month the surcharge originally took effect. Individuals successfully utilize this process regularly, but exclusively individuals who are aware it exists and who complete the filing. A critical point that almost no one recognizes: you are not disqualified from filing simply because the surcharge has already been active for several months. You are not barred because you have already absorbed several deductions. The filing window does not permanently close the instant the first adjusted payment processes. However, it does not remain open indefinitely. Every month of inaction represents a month of your own money that you may never recover. The error is never acting prematurely. The error is invariably the same: accepting the notice as a permanent verdict and taking no action whatsoever. And the overwhelming majority of eligible individuals never file, because the notification that increases your deduction does not arrive accompanied by the form that could reverse it. It never does. That asymmetry is the fundamental architecture of the problem. Now, the third change. This one operates with the least fanfare of the three, which is precisely the characteristic that will cause it to affect the greatest number of people. The physical Social Security check is being discontinued. For generations, tens of millions of Americans have received their federal benefit payment through an identical ritual: a paper check in the mailbox on a predictable day each month, a tangible document you could hold, examine, and carry to a bank or check cashing establishment. The United States Department of the Treasury is terminating that delivery method. Every federal payment is transitioning to electronic distribution, either through direct deposit into a personal bank account or through a government-administered prepaid debit card. The stated justifications are legitimate. Paper checks are vulnerable to theft. A check sitting in a rural mailbox on the same predictable date each month represents one of the easiest targets for mail fraud in the federal payment system. A stolen check can take weeks of bureaucratic processing and extensive documentation to replace. An electronic payment cannot be physically removed from a mailbox, forged, or fraudulently cashed. Paper checks also cost substantially more per unit to produce, process, and deliver than electronic transfers. The transition, evaluated objectively, moves payments to a more secure and efficient delivery mechanism. The threat is not the change itself. The threat is being unprepared when the change takes effect. There is an important nuance that even informed recipients frequently misunderstand. The transition is not voluntary. This is not a program that encourages you to switch and rewards you with a small bonus for doing so. The paper option is being eliminated. Once the deadline passes, the paper will not arrive. If you have not designated an electronic payment destination by that point, your payment enters a suspended status. It does not vanish permanently. The funds are not confiscated, but delivery halts until you establish an electronic method. And for a person whose monthly survival depends on that payment arriving on schedule, a delay of even a few weeks can produce consequences indistinguishable from a total loss. Moreover, the transition introduces a new category of vulnerability: electronic payment fraud, phishing schemes, fraudulent calls claiming to be from the Social Security Administration. Fake websites designed to harvest bank account information has increased dramatically in correlation with the push toward electronic delivery. Individuals who are unfamiliar with electronic banking are disproportionately susceptible to these schemes. The very population that relied on paper checks because they were simple and tangible is now being migrated to a system where a convincing phone call or email can redirect their entire payment to a criminal's account. Consider a man I will call Delmar. He is 78 years old, living in a remote area of eastern Montana. If you have never heard of the nearest town, that is precisely the relevant detail. It is a considerable distance from any significant population center. Delmar has never maintained a bank account. This was not ideological resistance or eccentric stubbornness. There was simply never a banking institution within practical reach of his daily life. The paper check arrived. It functioned. The system worked for him. Now Delmar has been informed that the paper delivery is ending. The fear he carries is elemental and absolute. If the paper stops, and he possesses no account for an electronic transfer to reach, does the money simply cease to exist? Here is the information he was never provided in accessible terms. A bank account is not a prerequisite for receiving the payment electronically. The Treasury Department administers a prepaid debit card, the Direct Express card, onto which the payment is loaded each month. The card functions identically to any standard debit card. It can be used at retail establishments, at ATMs for cash withdrawal, and for transactions that accept card payment. No bank branch visit required. No minimum balance, no monthly maintenance fees of the type associated with traditional checking accounts. For an individual in Delmar's circumstances, that single piece of information resolves the entire crisis. But no representative traveled to his area to communicate it. No clearly written notice arrived in language designed for someone unfamiliar with electronic banking. Beyond the debit card option, an additional provision exists for individuals who genuinely cannot manage any form of electronic payment. A hardship exemption is available through the Treasury Department. This waiver applies to individuals for whom electronic delivery represents a legitimate burden, geographic isolation, cognitive limitations, absence of any feasible access point. But the waiver is not automatically applied. No one enrolls Delmar on his behalf. The exemption exists in administrative documentation in an office hundreds of miles from his property, and it protects exclusively those individuals who claim it within the designated timeframe through the proper channel. There is yet another population segment that this transition jeopardizes: individuals who are unbanked not by geography, but by financial history. People whose previous banking relationships ended adversely through overdraft spirals, account closures by the institution, or involvement in the check system's reporting database may find themselves unable to open a new account through conventional means. For these individuals, the Direct Express card is not merely a convenience option, it is the only viable pathway. But awareness of its existence, the enrollment process, and the distinction between a government-administered card and the predatory prepaid cards marketed through commercial channels is extremely low among the affected population. Additionally, individuals in assisted living facilities, memory care units, or under legal guardianship face a compounded version of this challenge. Their representative payees, the individuals or institutions authorized to manage their benefits, must execute the transition on their behalf. If the representative payee is unaware of the deadline, incapacitated, or simply negligent, the beneficiary's payment halts through no fault or inaction of their own. Consider another individual, a woman I will call Hattie. She is 80 years old, residing in a small community in southeastern Louisiana. She does maintain a bank account. She has heard about the prepaid card option, but she has absorbed inaccurate information. From neighbors, from television segments she half heard, from the general atmosphere of distrust that surrounds any change to a system that vulnerable people depend upon. And she has concluded that the card is a fraudulent scheme, that the money loaded onto it can disappear, that it constitutes some form of government entrapment. Frightened by these false narratives, she is resolved to take no action and hope that the paper checks continue arriving. Let me state this with absolute clarity for Hattie and for every person who shares her apprehension. The government-issued debit card is not fraudulent. Direct deposit is not a deceptive mechanism. The genuine danger in this situation is not the electronic payment system. The genuine danger is paralysis. Allowing fear to substitute for a decision. Permitting anxiety to run the clock past the deadline. Here is what inaction produces when the paper delivery terminates and no electronic alternative has been established. The funds are not erased, they are not redistributed, but they are held. The payment enters a suspended state, waiting for you to designate a valid electronic delivery method. Your mailbox is empty on the morning the check always arrived. And for a person whose rent, medication, and food depend on that specific deposit arriving on that specific day, a payment that is technically intact but functionally inaccessible produces the identical outcome as a payment that was never sent. Please, if you have a parent, a grandparent, an elderly neighbor, or anyone in your life over 60 who may still be receiving paper checks, do them the single greatest financial favor available to you right now. Make sure they are aware of this deadline and help them set up their electronic payment method before the paper stops. Like this video, leave a comment, and subscribe so that you continue receiving this information as each deadline approaches. Now let me deliver on the commitment I made at the beginning. I told you that for one of these three changes, the majority of affected individuals already possess full qualification to eliminate the impact entirely. It is the first one. The premium consuming your increase. For a substantial percentage of individuals surviving on fixed incomes, the Part B premium, the deduction that silently reclaims the annual raise, can be covered in its entirety by a program they are already eligible for today. These are the Medicare savings programs. Multiple tiers exist, calibrated to different income levels. The income thresholds for qualification are set considerably higher than most people presume. Individuals who are convinced they earn too much to qualify are frequently incorrect. The assistance is not difficult to obtain. It is difficult to learn about. The overwhelming majority of eligible individuals never enroll. For one reason that never changes, no one informed them that enrollment was available. No one spoke the program name in their presence. No one placed the application in their hands. A related program that suffers from identical under-enrollment is the Extra Help Program for Medicare Part D prescription costs. Individuals who qualify for Medicare savings programs frequently also qualify for Extra Help, which subsidizes or eliminates prescription drug co-payments, deductibles, and premiums. The combined financial impact of enrolling in both programs can restore hundreds of dollars per month to a recipient's usable income. Yet the enrollment gap for Extra Help mirrors the gap for Medicare savings programs almost exactly. Eligible individuals do not apply because eligible individuals do not know the program exists. Similarly, many states operate supplemental programs, property tax freezes for seniors, utility assistance programs, state pharmaceutical assistance programs that use eligibility criteria aligned with or more generous than the federal Medicare savings program thresholds. An individual who discovers they qualify for MIS-P may simultaneously qualify for 3 or 4 additional forms of relief they were equally unaware of. The first inquiry opens a cascade of possibilities, but only if the first inquiry is ever made.